So imagine basically doubling your revenue in just 1 year, and then a casual $1 billion loan just drops into your lap from a single client, OpenAI. Crazy, right? Well, welcome to the Edgar Brief. Today we're cracking open the Q1 2026 10Q from Cerebras Systems, ticker CBRS, filed for the period ending March 31, 2026, and we are translating all that heavy accounting jargon into a plain English explainer. Quick note before we jump in, we're entirely independent, not SEC affiliated, and definitely not financial advisors. We do use AI to help summarize these massive filings, so errors can happen. Always verify the numbers on sec.gov before making any money decisions.
All right, here's our roadmap for today's explainer. We are going to cover the business model, the scorecard, the moat check, reading between the lines, and finally, red flags. Let's get right to it. Section 1. The business model. Moving from hardware to the cloud. So what does Cerebras actually do, who's buying it, and how does the money flow? For a long time, they were really just known as a hardware company building AI supercomputers. It helps to think about it like this. Traditional GPUs, they're kind of like a massive fleet of sports cars. Sure, they're incredibly fast, but if you want to move a giant payload, like training a massive AI model, you have to coordinate thousands of them all at once, constant back and forth chatter. Cerebras went entirely the other way. They built the wafer scale engine, or WSE. Instead of slicing up a big silicon wafer into hundreds of little chips, they kept the whole thing intact to act as one giant processor. So if those GPUs are a fleet of sports cars, Cerebras literally built a massive freight train. It takes completely different infrastructure to run, but man, it can carry a massive AI payload in a single trip, giving near-instant responses for AI workloads.
But how do you actually monetize a freight train? Historically, they just sold the physical hardware boxes to customers to put in their own data centers. But look at this Q1 2026 revenue split. Hardware is sitting at 57.2%, but cloud and services, that's rocketed up to 42.8%. They're rapidly shifting away from just selling the hardware to actually laying the tracks and selling compute power as an AI cloud service provider. So the cash comes in through those big upfront hardware sales and increasingly through long-term cloud consumption contracts.
Section 2. The scorecard. Let's look at the Q1 2026 financials.
Let's tune out all the AI hype for a second and just look at the raw math. Are more dollars actually walking in the door? The short answer is absolutely yes. Total revenue nearly doubled. We're talking a jump from $99.5 million in Q1 of last year to about $193 million. $193,406,000 this quarter. That's an explosive 94% year-over-year leap, mostly driven by that pivot into cloud services we just talked about, along with some really solid hardware demand.
Next up is gross margin. This basically tells us how much money sticks around after you build the product, but before you have to pay for payroll, rent, and ads. They bumped this up to 44.6%, up from 41.8% a year ago. Management notes this was driven by getting cheaper materials and better manufacturing efficiency on the hardware side, plus better pricing in the cloud.
Now, here's where we need to put on our investor hats for a second. On an income statement, accounting profit can sometimes be a bit of a fiction, heavily skewed by non-cash charges. But cash is definitely not fiction. That's why we look at operating cash flow, the real, actual cash generated from everyday business operations.
And this right here is the crucial point. If you just glance at their accounting scorecard, you'd see a $15 million operating loss and think, uh-oh. But flip over to the cash flow statement, and their actual operating cash flow was a positive $12.3 million. Why the huge difference? Because they had a ton of non-cash expenses, like depreciation on those massive data centers and stock-based compensation for their employees. The real takeaway here? Underneath that accounting loss, this business is essentially a cash cow in training, bringing in more real cash than it's sending out.
Section 3. The moat check. Durable advantages.
Okay, so they've got growth and they're generating cash. But what's their durable advantage? Why can't a tech giant just crush them tomorrow? Well, Cerebras actually possesses some incredibly unique structural advantages. First off, nobody else had ever successfully commercialized a full wafer-sized processor before. Working with their foundry, they literally had to invent the proprietary manufacturing techniques, the advanced packaging, the cooling systems, all of it just to make this work. That is a massive technical barrier to entry. Second, switching costs. Once a client like OpenAI builds their infrastructure and writes their software to run on a Cerebras engine, ripping all of that out to switch back to regular GPUs would be incredibly painful, expensive, and time-consuming.
Moving right along to Section 4, reading between the lines.
The OpenAI pivot. Every SEC filing tells a hidden story, and we need to unpack this sudden operational shift driving this company. This single sentence is essentially the center of gravity for the entire 10Q. Late last year, in December 2025, Cerebras signed a master relationship agreement with OpenAI to provide 750 megawatts of AI compute capacity. And to make it happen, OpenAI handed them that $1.0 billion secured working capital loan to build out the infrastructure. If we read between the lines here, Cerebras is essentially building a massive, dedicated ecosystem that revolves entirely around OpenAI. This one mega client deal is the absolute engine driving their whole pivot into the cloud. And because they're building so much infrastructure so fast, we're seeing something called pass-through revenue show up. Think of pass-through revenue like a landlord handing the water bill directly to the tenant. You bill a customer for the exact cost of something, like electricity or rent, at zero markup. In this quarter alone, $4.1 million of their revenue was just pass-through costs. Now sure, that dilutes their overall gross margin percentage, but it's an absolute zero margin necessity for building out OpenAI's massive footprint.
Which brings us to Section 5, Red Flags, the existential threats. Look, every investment has a bear case, right? And we need to dig into the threats buried deep in the risk factors. Cerebras has two glaring vulnerabilities right now. First is single customer concentration. They are incredibly reliant on OpenAI, not just for future revenue, but remember that $1.0 billion loan? They have to repay that using non-cash service credits. If OpenAI breaches the contract or if Cerebras misses their incredibly strict delivery timelines, OpenAI can pull the plug and demand that loan back in cash immediately. Ouch. Second, single supplier risk. Cerebras relies 100% on TSMC in Taiwan to manufacture these giant wafers. There are no backups, zero. If TSMC halts manufacturing due to geopolitical tensions, earthquakes, you name it, Cerebras cannot make its chips. Full stop. It's a genuine existential vulnerability. And finally, the bottom line, our objective verdict. Let's pull all this together. Cerebras is a hyper-growth AI hardware turned cloud provider. They've got massive scale advantages and they're bringing in real operating cash flow, but they're operating with extraordinary concentration risks tied to one key supplier in Taiwan and one massive customer in OpenAI. If you're tracking this company, here are the three critical things to watch in their next filing. Number one, watch that mix between hardware sales and cloud revenue as they fulfill that OpenAI contract. Number two, keep an eye on gross margins as those zero markup pass-through costs start to scale up. And number three, watch closely for any commentary on TSMC supply chain stability or efforts to find backup manufacturing. I want to leave you with this provocative question to ponder. Can Cerebras actually use this massive momentum to diversify its client base before those OpenAI capacity commitments run out? And that's your Edgar brief on Cerebras Systems. Remember, this was a translation, not a recommendation. Read the original filing on sec.gov if anything we discussed today piqued your interest. Thanks for being with us at the Edgar Brief. We'll see you in the next filing. Note, sources drawn directly from Cerebras Systems, Inc., Q1 2026, Form 10Q, specifically Item 1, Financial Statements, Item 2, Management's Discussion and Analysis of Financial Condition and Results of Operations, and Part 2, Item 1A, Risk Factors.